All right. Hey, hope you are doing well. We're coming up here, America the Great. We're coming up on election moment next week ahead. But really, what we're focusing in on is interest rates. What's going on? What's the great word? What's happening? Interest rates are down, but interest rates are up, right? Like that's kind of the perplexing question that people have. We've seen that the Fed cut interest rates 50 basis points at their previous meeting. And then now in the last 30 days, the 10-year Treasury's up, almost 50 basis points, right? And people are like, mortgage rates are up. What's going on? Well, the Fed controls the overnight rate and controls what is the variable rates for ultimately the basis for overnight lending at the banks, and then in turn is impactful on variable rate loans on real estate, line of credit for businesses, credit cards. Ultimately, a lot of times also what will be happening on various loan rates for automobiles, et cetera, things like that. The bond market is what is more controlled in the longer term rates, so like Fannie and Freddie Mae, or your traditional 30-year home mortgage as well. And so, fortunately or unfortunately, right, what we have been looking at and what people have been looking at with the data, so to speak, is that the economy does seem to be, on not firm foundation, but it's on decent foundation and less speculation or less thought process of an impending recession. That the potential is that there may be the holy grail of a kind of a soft landing as they're, moving interest rates down, having been moved up to the highest that they've been and the fastest that they've been in 40 years. Now that interest rate movement and to combat, inflation and to slow the economy down has been, some people would say somewhat effective, no doubt. It's definitely put a hurting on certain areas of the economy and commercial real estate, and we've seen and talked about that. But what's really going to be happening with interest rates? Well, so less professional money and money in whole is going into bonds as there is the thought process or thesis that the economy is staying stable. And so then you have interest rates that are in the bond market holding up better than what would have been expected. That being said, though, the Fed is still going to be moving rates down. Like their next meeting coming up here in November and December is still penciling in for a 25 basis point cut potentially at each meeting. They are penciling in at least 4 cuts next year to get back to a more neutral rate of, call it, say, 3%. Ultimately, rates are going to be going down. And so what that means for you as an investor is that many people have money in their money market accounts earning 5% still. That rate's going to be coming down. I mean, there's no doubt that even with the last cut, maybe it didn't happen at a lot of money market accounts, but it's fixing to happen where they cut it in November and December. Rates will be going down. The other thing that you can look at and foresee is that we are in the likelihood of a declining interest rate environment over the next 18 months. There still is going to be this, kind of wonkiness in the bond market. If there is further softening in the economy, that will also push, more money into bonds, which pushes prices up and then pushes yield down. So again, what does that mean? You've got to begin to take a look at and think about over the next years ahead. If you're talking about the next 2, 3, 4 years, you've got to look at the options that are going to increase your returns because that 5% money market rate's not going to be there for you. And so I know a lot of people put money in there just as a wait and see kind of thing. But yes, you still need to maintain the money you need for your personal liquidity. Typical minimum is, estimated to be 3 to 6 months. Sometimes depending if you're a retirement status, maybe it's a year's worth, but money that is there and available for you for liquid. But then the other portion of that, you want to be looking at how can you begin to sensibly and securely begin to deploy that money where you're getting a higher return. And so there's lending vehicles, the apartment space that we talk about as well. There's a number of variety of ways that you can look at to securely begin putting that money to work so that you're not experiencing a 5%, 4.37, 4.75, 4.5, 4. I mean, that's ultimately what's going to happen. And so that, 18 months from now, that money market account's yielding 3%, which is, on par with inflation. So you're at a net neutral. So again, just being aware of it, and hopefully also that answers the question of why interest rates are up when interest rates are down as well. Hey, thank you so much. Have a blessed and victorious week, for this is the week God has ordained for you.